Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show. I'm your host, Dan Breslin, and this is episode 149 on turnkey and BRRR-Key rentals with Allie Boone. Today we take a deep dive on the evolution of turnkey providers throughout the country, more specifically the disappearance of many turnkey providers once the going got tough. Those in the market today have had to deal with pushback. Those turnkey providers, that is, that are still successful, have had to deal with a pushback from the buyers because of an expectation of a better equity position from day one, which is really a symptom of the more normalized, lower appreciation expectation real estate market in which we find ourselves here now in 2020 versus 2011, 12, 13, when the expected appreciation rates were much higher, making it worth the risk for the turnkey buyers to hang on to the rentals during that time. Hence, we have the BRRR-Key offering. That's the buy, rent, refinance, and rehab, where providers identify, renovate, then manage the investment fully funded by the buyer on day one, taking a profit for managing the process while leaving an equity position for the investor. Let's jump in with Allie and get started. All right, welcome to the show, Allie. How you doing today?
I am great. How are you? I'm so excited to be here.
Yeah, I'm excited too. I mean, I've been looking forward to our episode for a while. It took us a bit to get it on the calendar, but you know, here we are. We were joking about the weather. My audience here knows I'm in Chicago. The lake's going nuts today. We talked about that before. And I told you to be quiet when you told me you were in California about the weather before the show. But
Southern California, even worse. Oh, it's like, I don't know, it's like 65 and sunny, and it's only 11 a.m. It should get up to like 70. But I mean, that's cold for SoCal, so we're all bundled up in our parkas and stuff, so.
Yeah, I mean, we kind of do the weather commentary on a bunch of the episodes, and there's a big contrast depending on the time of the year or the place where our guest around the world happens to be recording, so I appreciate that little bit of background. But for some real estate background, Allie, would you mind sharing with the audience, like, you know, how you got started in real estate, maybe what you did before, and a little bit of the Reader's Digest of what your business looks like today?
Sure. So my background was actually in aerospace engineering. I was working in that field, and it was one of those situations, you know, I went to school for it forever, and then the very first day I ever walked into my first job, before I even sat down in my cubicle, the thought in my head was like, oh, I've got to get out of here. I knew it. I was like, oh boy, oh boy. And so corporate wasn't my thing. It turned out engineering wasn't really my thing. I definitely have engineering tendencies, but otherwise not really my thing. And so immediately I started trying to figure out, well, how am I going to get out of a corporate job? And it took me about 5 years to figure it out, and I was bouncing between, do I start a business? You know, when you read books, you kind of figure out that you either have to start a business or do something in real estate. Those seem to be like the two main things that got people out of 9-to-5 jobs. And I had decided to go the business route. I didn't know what business to do, but not long after that, I got this. I had, of course, subscribed to every email newsletter on the planet at this point because I was trying to do anything other than engineering, so I was preferring to check my inbox. And I got this video for, I think it may have been through Think Realty or one of those people who had this advertisement for this webinar for this pre-construction deal actually in Nicaragua. So my first investment ended up being a third world country, but I always like a good story. And so I pursued this deal, and through that, that deal ended up not doing a whole heck of a lot, but you know, at that time, it kind of put the real estate bug in me, and I was meeting people at this point. I was figuring out that real estate investors were definitely my people. Like, you know, we all have a certain level of intelligence, but there is a sense of adventure there. And I was like, man, okay, this is cool. And so I just kept diving deeper, and so the people that I was working with on that deal were also involved with turnkey rental properties, and I'm sure we can talk more about that model later, but it was, at the time, Atlanta was one of the biggest markets, and I was from Atlanta, so they approached me and said, hey, you know, just a heads up, our next market is Atlanta, and we know you're from there, so if it's something you're interested in. So at this point, I really wasn't seeing the way out of corporate, but I was seeing something smart to do with my paycheck, because I knew if at some point I left the corporate job, I wasn't going to have that fancy W-2 paycheck anymore. So I thought, well, I'll just start investing on the side while I still have this. And then one thing led to another, where I was so excited about everything. I was telling everyone and their mothers about turnkey rental properties, and one thing led to another. I got my license and I started referring people to these deals, and it became such a big thing that I ended up leaving my corporate job for it. So I have been doing that now for a little over kind of in the 7 to 8 year range. And so now, ironically, I thought I was going to go business or real estate, and I ended up with a real estate investing business. So I've been working with the whole 7, 8 years. I've been working with people buying turnkey rental properties and helping them, kind of being a hand holder. And turnkeys are really cool because they attract a lot of new investors. So that's kind of where I come in as a support system. And I do a lot of matchmaking and connecting buyers and sellers, and I was a writer for Bigger Pockets for a long time. I've done some real estate writing for Motley Fool and some other websites, and yeah, so that's kind of where it is today.
Nice. That's pretty cool. You say, so I'm in Atlanta, we're in Chicago, we're in Philadelphia, 2 hours around any one of those cities, and we did 224 deals last year. In the three markets for a total of like $5.2 million in gross profit amongst all the partners. We do that volume of deals. I share that so that you see like the perspective is like I've seen what happened in Atlanta, and like I'm kind of wishing like, man, I wish I was all right even 5, 6 years ago, even 3 years ago, to have bought a turnkey rental at full retail value. Because I assume most of the turnkey stuff, Allie, that's like you're buying it kind of like retail-ish numbers, but it's already in place and the tenant's there, right?
Yep, exactly.
What has happened for some of the people, that have bought at those retail prices, and it probably didn't look like this great cash flowing opportunity? Because a lot of people see turnkey and they roll their eyes, especially the experienced investors. But like, how did those investments mature for some of the clients that you had 3, 4, 5, 6 years ago?
You'll probably want to know this less than you want to know about Southern California weather. So the unique thing about Atlanta, so I was buying in Atlanta in 2011 and 2012. And so like you said, you know the time frame of Atlanta. So all of my turnkey properties that I did buy at around market value at that time have since doubled and tripled in value because of what the Atlanta market did. And that's also why we've since kind of moved out of Atlanta, because now we're on the other side of that curve. But, that was a unique situation. So with the turnkeys, you are buying at market value. There is cash flow. And actually the same thing happened with Dallas. I think it was, give or take a couple of years, maybe 2012 and 13, kind of a similar dynamic happened where we had a lot of people buying Dallas, and within a year, their property values had increased like 40%. So in those cases, the market really forced the appreciation that investors are really looking for. And you brought up seasoned investors. Absolutely. Turnkeys, I have a lot of people come to me and say, well, should I buy a turnkey? And either they're in a market that they could get cash flow on their own. There's different reasons. And I'll say no, like don't buy a turnkey, because if you are a seasoned investor and you have the skill set to do these properties on your own, to do value add, you have the interest, you have the time, you have the resources, go do that, because you are going to get that under market value. Whereas the turnkeys are market value, but what that allows for is really for the people who may not have otherwise gotten into real estate. Like I was one of those people. I'm not handy. I really have zero interest in working on my investment properties. That's the biggest thing for me, is I just don't want a job in that field. And that's what you end up doing when you end up working on properties. So for me, I had previously looked at a lot of properties and they were going to require work, and I was just like, I'm just not seeing it. I don't want another job. And so when turnkeys came around, that's how I ended up really getting in. And so that's why I think I mentioned earlier, a lot of new investors it's great for turnkeys. So seasoned investors, they do kind of gawk at turnkeys because you're buying market value. And right now where we are, we're not in an Atlanta or a Dallas situation where you're going to pay around market value. There's not a whole heck of a lot of markets that are scheduled to appreciate that much. Like, you'll still get kind of normal appreciation, but it really is a cash flow play. But, when you look at it on the bigger picture, it's a trade-off, right? So, yeah, you're not forcing the appreciation, but you are getting, for new investors, what I love about turnkeys is, and you as an investor probably know this too, is there's a lot of basic fundamentals about real estate investing that people don't understand. Like, I remember looking at my very first potential rental property, and I heard all the numbers on it, and I was like, I don't really know what I'm looking for or what constitutes a good deal, but something about this doesn't make sense. Like, it was a really high purchase price, the rent wasn't going to cover. I just didn't know what I was looking for. And so turnkeys, when they take all of the hard stuff out, like rehabbing and detailed market analysis and neighborhood analysis and management and all that kind of stuff, it really allows you as an investor to learn due diligence, which is easily one of the most important things, if not the most important thing, how to run the numbers, what are you looking for in a property, what makes for a good property, and, so there's pros and cons to turnkeys for sure, and, again, seasoned investors, if they already know how to do all of the work, they're probably not that interested in turnkeys, but turnkeys really do offer a unique entry point for people who may not have otherwise gotten into it. Like, I'm in Southern California, and you cannot get cash flow here. So if you want cash flow and you want to buy out of state, but you don't want to personally be responsible for having to, manage this out-of-state property, that is an option. So kind of a long-winded answer to your question is, back when I was buying, it was very different as far as what those portfolios look like now. As far as the people who have been buying the last 1, 2, 3, 4 years, as far as I know, they're all holding pretty steady. The cash flow is still there, and there is always going to be appreciation on some front, just not like, the Atlanta days that are more exciting than Southern California weather.
Did you really know, or did the people you knew know at the time that it was going to go double and triple? I mean, was that kind of what they were talking about, or was that like a pleasant surprise?
Nobody said specifically double and triple, like nobody said a specific number, but it was a pretty known thing that the curve was going to be huge. Like, it was, I honestly can't even remember what all was going on at that time. The big thing that really, the first thing more than the appreciation potential, because anytime anyone's looking into turnkeys, they're not focused on the appreciation, like they're cash flow plays. And so appreciation everyone just kind of considers to be a bonus. So the biggest thing that was going on in Atlanta in 2011, 2012 was the price to rent ratios. So I guess I will kind of drive in, we'll call it Southern California weather, but my very first turnkey that I ever bought still is this really cute 2-story little yellow house. The neighborhood was pretty decent. It was probably B to B plus level, and it was fully rehabbed with tenants. And I bought it for $55,000, and it was renting at the time for $975. So if anyone listening knows about price to rent ratios, the big thing is the cost to own that property was so low, and a $975 rent on a $55,000 house is ridiculous, like that in a good way. And so that cash flow is huge, and that was really that's really kind of what started Atlanta, because there was this big gap in the housing prices and the rental demand. And so that's what really turned people's heads towards Atlanta to start with, was these price to rent ratios, because you could buy a $55,000 house and rent it for almost $1,000 a month, which was absurd. But at the same time, because of that dynamic, and there were a whole bunch of industries coming in. The movies were just starting to move into there. There was all this stuff. So everybody, they knew it. Like, the boom was an impending boom, really. And so I don't think anyone said necessarily double to triple values, but it was a curve. Like, it was a big one coming. And again, same with Dallas, where Dallas wasn't quite as dramatic. Their price to rent ratios were still good at the time, but it wasn't so insanely good like Atlanta. But they were also anticipating that same boom. And then, so sure enough, Atlanta boomed. And I haven't even talked to a lot of Atlanta investors to see, what all their properties are doing. But I still have all of mine, because I'm like, well, shoot, if it's already double and triple, like, let's see how far this goes. And so, yeah, it was an exciting time. I mean, it was a feeding frenzy. And for me, having just gotten into real estate at the time, it wasn't necessarily tough to navigate, but looking back, now that I'm a lot more familiar with turnkeys, I mean, at that point, everyone and their mothers had started a turnkey company. So, most of those companies are out of business now. Like, turnkey companies now, the ones that are still out there, have been out there for a while. They're pretty sturdy. They know what they're doing. But back then it was such a feeding frenzy. Everyone's like, yeah, I'm a turnkey provider. Buy for me. And everyone's like, okay. And, you know, the hedge funds were buying everything up. They were buying up Atlanta and Memphis at the time. I mean, as investors, everything was on sale. I mean, it was like a clearance rack from heaven. And so now, you know, we just don't have that dynamic going on now, but it was definitely fun. And I try never to say it out loud because I realize it affects most of the world pretty negatively, but I would love another crash to happen because, you know, as investors, that is, I mean, it's like party town at that point.
Yeah, and it's funny you mention that. So if you actually dig into the numbers, the economic data behind this crash, there has not been ever a real estate crash in history that was to the magnitude that we had in 2008, 9, and 10. The closest thing that we did have was the Great Depression, and people were starving then. So we really didn't have the run-up and the characteristics. And it's like, I'll give a resource out here if anyone's listening. Hoya Real Estate Capital publishes like weekly newsletter data. They have an index fund that trades publicly for housing related stocks, builders, financial, etc. It's Hoya, Hoya Capital Real Estate. So if you Google them, check it out, get on the list, you can check out like a lot of these the characteristics. And one of the things they shared today, I just got the email before we got on our call here, was the employment of, I believe, prime people, maybe like 25 to 54 years old, and we are still not below, meaning like the number of people who are employed in that range, even with our like record unemployment levels and things, there's still this very large number of people that's like, it hasn't gotten better than it was pre-2010, I believe. And I could have the number. It might be pre-2005. So we still haven't even seen like a complete and full recovery yet. And if you look at that compared with the number of properties that were built before the crash and then after the crash, we've been running a really strong deficit, meaning they hadn't been building and replacing the outdated houses. So it's like, just to kind of like put the icing on the cake of how far can it go? I think it could potentially go significantly farther if the real estate, if the interest rates continue to cooperate, because we have still kind of like this shortage as millennials are actually buying houses now instead of only renting.
Yeah, no, absolutely. And especially Atlanta in particular. You know, Atlanta, I mean, I'm from there, and so for a while I was going back there to visit. And I mean, truly, even the traffic there now, I mean, last time I was there, I was like, if I wanted LA traffic, I could just stay in LA. Like, Atlanta has boomed so hard. I mean, the traffic is painful. And, you know, Atlanta's not going. The cool thing about Atlanta and a lot of the southeastern cities is their housing prices are just really low for, you know, whatever reason it is. And so Atlanta started with really low housing prices. The houses were great. There was nothing wrong with them. It just was kind of how the market was. So, you know, my thought about it has been, aside from the market itself growing, you know, at some point Atlanta's probably going to catch up with the rest of the nation, you know, and so there's definitely, I'm not getting rid of and plus $55,000 property. Hello. that was great.
Yeah.
So yeah, I'm planning to hold my properties there for sure.
And that's a trend I've noticed in the markets I mentioned earlier in our episode here. There seem to be these, if we looked at the entire country and we're saying Atlanta and Dallas and Philly and Chicago and the rest of them, one fact people probably are aware of is that the property taxes are much lower in Atlanta and also Dallas than they are in like a Chicago or Philadelphia. Philadelphia city's not too bad, but when you get out into the suburbs, it starts to get really high in the northeastern United States. But if we look at the country and we're like trying to segment different markets, Atlanta's great and this one's great and this other one, like you may not find in Southern California, you can't cash flow. It kind of knocks that one off the radar or out of the consideration at all. But in Chicago or in Philly and Atlanta, and I suspect other cities where I haven't done it, you can actually like micro research those markets, and there are properties in the last 3 years in Atlanta that I've seen in the last 3 years that have gone from 55,000 to 155,000 that have gone, and that would be like so you still have these like little micro areas in the markets. I bought a couple of them a few years ago. People on the show probably remember me talking about them, and I felt like I was paying like a retail price to this guy. I think I bought 6 properties at once, and the rents were okay. It wasn't like this great, it was definitely nowhere near as great of a cash flow and situation that you just described on your 55K deal. And I felt like, man, I'm overpaying for this stuff. This stuff is through the roof. It's already doubled in the last couple of years. Like, I'm going to try to ride the trend, and I'm going to put my money where my mouth is and buy it. And like, you know, a year later, it was worth another 30-40%. So the trend continued, and that neighborhood is, you know, it's continued. I mean, retail stuff there sells for $200,000 to $250,000, and I bought them for, you know, 67. They're not renovated yet. I would have to put 50 into them, but just as an example, and then the rents are going up. So like, I think what I experienced, I picked the right area in the city that still has some room to move, as opposed to just throwing a dart and picking anywhere in the city. But then also I kind of feel like I've experienced more of the, I would say like more of the usual, not like this stellar unicorn experience that you had in Atlanta, but more like this is what real estate typically has done, that our like forefathers talked about why it was such a good investment. As rents inch up and appreciation inches up, I mean, it's not going to be 35, 40, and hasn't been since that year for me, but I think it's been, I don't know, 4 or 5% probably steady in the 2 years that followed that one, and they're continuing to grow and continuing to climb. So there's still like that residual benefit in a vibrant enough real estate market where even the turnkey buyers who have bought now, I'm not saying everybody should run right out and buy turnkey rentals, but for the person looking for them in the right location in the right city, it's still probably a good investment, right?
Yeah, for sure. Yeah, and I mean, there's, you know, we could have I could go on for an hour. We could analyze stuff to death, but, you know, the thing with a rental property, too, is a rental property has 5 profit centers, right? So there's cash flow, there's appreciation. Everybody knows those two. There's the tax benefits, which are absurdly fantastic for rental properties. There's, you know, your tenants are paying essentially your mortgage. So you're building equity via the mortgage pay down, but they're the ones paying it. And then the indirect profit center of hedging against inflation. And so the advantage of having 5 profit centers, like with my properties over the years, you know, I had one property one time. It was kind of a freak of nature. We just could not get it rented for like 10 months or so. I mean, it was stupid. It was the nicest property I have. And it was Atlanta went through a weird phase, and and my property manager was terrible. But so, you know, I was talking to one of my mentors, and I was just really stressed out. I was like, man, you know, here I am paying this mortgage, and like, and he was like, cool, I hear you. He said, but, you know, we really kind of ran through, I don't want to say we formally ran through the profit centers, but that property more than anything had appreciated, it was something stupid at the time. I mean, it was like tons. I mean, it was just tons overnight. And, you know, when I was able to really kind of sit back and look at it, I was like, wait a minute. Yes, the cash flow, the non-cash flow kind of sucks, but I am getting money on this from a lot of different areas. Like, this is actually way more profitable than I thought. And so, you know, that's one of the things is that a nice thing about rental properties is you do have multiple income streams. And so if the appreciation isn't happening for a minute, maybe you're getting it on the cash flow. Maybe, you know, you have room to, you know, let the market do its thing. And if you're buying right, and, you know, one thing I like about turnkeys, appreciation is a little bit more on the minimal side, but, you know, all 5 of those profit centers are being supported. And so at any one time, if one of those has to kind of slip for a minute, you know, I'm not totally in the hole right away where I would be if it was just one income stream. So, you know, that's why rental properties in general, assuming you buy right, because that's what I really didn't understand when I got into it, is I didn't know the numbers. I didn't know cash flow. And I grew up, I'm sure a lot of people did. I just heard that if you owned rental properties, you were rich and profitable. And the reality is most properties don't make for a good investment, and people don't realize. They're like, I'll just grab this one. And, you know, I hear people talking about house hacking in Southern California, for example, and I'm like, cool, I hear you. So just out of curiosity, how do you specifically plan to profit from that? Because people hear, house hacking is a great idea. You know, instead of owning or renting or whatever, then I'm owning, but I have renters to help me. And I'm like, okay, yes, that it can work that way. But if you actually run the number, and people then talk about doing it with an FHA loan, it's only like 3% down. I'm like, here I am like suffocating. I'm like, okay, hang on. So you're going to put 3% down, paying PMI on, I don't know, $1 million property in Southern California, and you're going to house hack, so you're going to have a couple renters, you're still so far in the hole every month. Like, what is the profit plan? And so, it's all these ideas that we all grew up with of, oh, house hacking is so profitable, and, oh, owning a rental property is so profitable. Yes, it can be, but it's not every property. And, so when people really take the time to sit back and learn those things, when you can buy a property that actually supports profitability, and you have to be able to say, like, okay, here's how I plan to profit. That's kind of my, like, if you can tell me that, cool, do what you want. Like, I totally support you, but a lot of people can't do that. And so it's that, if you find something that supports profitability, we all know this is a real estate podcast. It can be fantastically profitable and just very good on a financial well-being kind of standpoint.
Speaking of buying right, Allie, can you talk a bit about BRRR-Key, which sounds like something that's, maybe bigger pockets? It's kind of...
It sounds like a noise that everyone in Chicago is making right now. Brr.
Oh, yeah.
Yeah, totally. So this is kind of the more exciting... This is kind of a great segue because we've been talking about how much it kind of sucks to not be able to force appreciation on the turnkeys. So for anyone listening not familiar with the turnkeys, the turnkey rental properties are properties, in the context that I talk about them and that most people are talking about them, there are companies out there who go out, they buy tons of distressed inventory, they rehab the properties, they place tenants in, they have property management on standby, and you as the investor go in and buy one of these finished houses. So it's, I'm one of the culprits I used to call them hands-off rental properties. I very quickly learned not to do that because it kind of gave people a message of they can just check their brain at the door. And I'm like, okay, well, that's not what I meant. But, they're about as hands-off as you can get. So the rehab is done for you. You're really just doing the minimum. Your biggest job really is due diligence. And so the major advantage to a turnkey is that you are able to verify pretty much everything before you put any money down on it. So aside from any freak of nature occurrences and, unknown repairs or vacancies, you can double check the condition of the property, you can do market research, you can do comps, you can do everything before you slap a dollar down. So that's a major advantage aside from being hands off. But the downside, like we've just been harping on, is there's not really a way to force appreciation once you buy it. And that's really a lot of people's big beef about turnkeys. So there's a unique option now where everyone's probably, if you've heard of the BRRRR model, which I just hate that acronym because I can never figure out how many R's are in there. It's the buy, rehab, rent, refinance, repeat, something like that, where it's basically the old school value add. So you buy a distressed property, you rehab it. By doing that, you're forcing the appreciation, and you as the investor get to keep that additional equity that you've now just forced. And that's the upside, which is in direct contrast to the turnkeys. The downside obviously being that you have to do all the work. There's a lot of risk that comes in because there are so many unknowns. You can't verify a finished product before you put all the money in and stuff like that. So the turnkey providers got pretty privy to the fact that people were getting kind of frustrated paying market value for things. I mean, it's justified. It makes sense. But the turnkey providers also need help with funding. So, they're basically glorified flippers. And so what a lot of them started offering was they're going to give you the turnkey property or the turnkey product, but instead of them being the ones to fund it, you're going to do it. So you buy the distressed property in your name. Hopefully, I recently heard of a BRRRR-Key provider that they buy it in their name, and that just screamed red flags all over the place to me. But I was like, oh, mayday. So you buy the distressed property, and they help you identify it. They help you with the market. They're really offering you the same resources that you would get with a regular turnkey. So you get their expertise and all that. So they help you identify a property. You buy the distressed property, and you are funding the rehab, and you don't give it all to them in one chunk. It's different milestones or whatever, just different levels of draws. But essentially, you're combining the perks of both the BRRRR model and the turnkey model. So you are getting the forced appreciation because once they do the rehab and all that stuff, you're the one who gets to capture the appreciation on the other side. So if you're $100K all in for the distressed property and the rehab, and now it's worth $120, $130, that's yours to keep. But then you also have the perk of the turnkey where they're still doing all of the work for you. And that's the exciting thing about this, because especially in today's market where appreciation isn't as strong as it was in 2011, 2012, you are able to force appreciation right out of the gate, which is exciting. The downside, one downside for especially newer investors is it does require, 90 to 100K cash up front. And so what happens is, once the property is finished at the 6-month mark or whatever the seasoning period is, you then do a cash out refi and pull all that money back out. And what that allows you to do is keep more money in your pocket than you would have with the standard turnkeys. So the standard turnkeys, you're putting 20% down every time. So if you only have a couple sets of 20% down, you can only buy a couple properties because you don't have a way to bring that money back out. Whereas when you're forcing the appreciation, that cash out refi is based on the new value, which means when you only keep 20% in, you're actually pulling in some cases, you're pulling all your money back out. And so once you do that, you can it gives you an option to rinse and repeat. So one downside is if you don't have that much capital up front, it's a little bit of a hindrance. But then the major risk side is that you are handing that much cash to this company who swears they're going to do the job for you. And obviously the biggest risk being they take your money and move to the Caribbean, which I may or may not have heard of one of those cases. So, the big thing with the BRRR keys, as we've come up with no better term for them, is you have to know who you're working with. Like, if you're buying a standard turnkey, it's very helpful to work with a really solid, reputable provider. But again, you're able to verify everything before you close on it. With the BRRR keys, it kind of goes against everything we all know as real estate investors, but you have to figure out a way to trust these people. You can have every contract signed and, contracts are trash if the guys move to the Caribbean and, you can only go so far with it. So,
and money's gone.
Yeah. And so, it's a really exciting model. I'm working with one BRRR key provider now that I fully trust. He's the kind of guy that will literally lose sleep if your property is not performing. And I love these guys. But, there are various turnkey providers that are offering this. And people ask me, and that's one of those things, I have got to know who, it matters who's doing that model because, it's a unique situation where, if you're doing the BRRR model yourself, you're kind of in charge of everything, you're running everything, but in this case, you're kind of handing your money to somebody else. And again, there are contracts in place, there are, whatever, but at the end of the day, it's a riskier model. So that's the trade-off, right, is you get to capture that appreciation, you get everything from a value add opportunity, but you are taking on an added risk of not really being able to verify a whole heck of a lot before it's completed. And, so you've got to work with somebody reputable. But, yeah, it's a really cool, unique offering for the people who are interested in the hands-off turnkey aspect, but do kind of want the appreciation, or they are looking to build their portfolio faster so they can rinse and repeat and snowball this. And, but again, maybe they're long distance, or they work a full-time job and they don't have time to be doing rehabs themselves, or if you're like me, you have no interest in doing a rehab yourself. So yeah, it's kind of a cool, happy middle ground, which is very exciting. But again, anyone listening, if you are approached with a BRRR key model, again, you have got to know who you're working with on that front for sure.
So you're working as a matchmaker oftentimes between, investors who are looking for turnkey or BRRR key and the providers. That said, what is your process for vetting, the other end of the match, the provider? If any, how are you mitigating that risk on behalf of your clients who are coming and looking to buy the turnkey or BRRR key investments? Yeah. What's that process look like for you when a new one's onboarding?
Yeah, so I actually work with a team of folks, and I can promise you I'm not the smartest one of the group of us in the vetting side of things. One thing I have it's ironic because I love a good spreadsheet. I used to be an engineer, but I hate detailed market analysis. It's just ugh. And, I hear about people doing detailed market analysis. I'm like, cool, but what's what does that translate to? Like, I live in Venice Beach here, and I looked at crime stats one time, and based on the crime stats, I should have been beheaded about 6 years ago. So, it's kind of like there weren't actual beheadings on there. And, it's like, so what I've really kind of put in place over the last few years is finding the people who are really good at the different parts of this equation. So I'm actually better on the buyer and hand-holding support system side, because one thing I'll tell you about turnkeys, whether it's BRRR-Key or regular turnkeys are not known, or the turnkey companies are not known for customer service. There's a couple exceptions to that rule, but I mean, for the most part, customer service is just dreadful. And so my role usually ends up becoming kind of being that buffer. Like, I really, especially with the new investors who are fearful and they're scared and they don't know what they're asking, and I've really kind of stayed more on the buyer side. But my teammates who I work with, they do more of the turnkey provider vetting. So, for example, we absolutely will not pitch a marketer or provider that one of us has not been boots on the ground with this provider. Like, a few years ago, I went out, we had a Philly provider actually who we don't work with now, but I went out, we toured the whole operations. I actually just did this with the BRRR-Keys in September. I had hosted an investor trip to go check out these BRRR-Key operations. This was in Baltimore. And, really sit down with the providers and really, again, this goes, it's kind of one of those difficult things. There's different things on paper I can check all day long, but sometimes it takes being in the room with a person to, really communication with this person to see am I talking to a seemingly decent human being? And surprisingly, you can kind of tell that difference on occasion. So a lot of it for me is communication with them. It's really seeing their operations. When I go tour the properties or I take investors there, we see both pre-rehab and rehab, because we can kind of you can get a better feel that way for what's the quality of this thing. And, you've got so many team players, and with the providers, but I was about to drift somewhere and talk about property inspections and all that, but back to the turnkey providers it's sitting in their office, it's meeting all of their teammates, it's looking at their leases, looking at their contracts, seeing all the properties, and it really is a boots on the ground thing. I have a lot of turnkey buyers, because most turnkey buyers end up buying sight unseen. They're busy with other things, they're not local to it, they've got the property inspector to confirm things, and and people say, do I need to go see the property before I buy it? And I say, no, you don't. However, if you can go see a property, and this is not advice that I would give for outside of turnkey world. If you're outside of turnkey world and you're not going through one of these reputable providers, absolutely, I think you should go see the property. I've been tricked by pictures millions of times, but for the turnkeys, it's oh, really? How much did you pay that photographer to make it a whole new house? That's cool. And so, it's, if you have the chance to go see it, because anytime you're in person, again, I've got teammates, they do all the market analysis, they do the hardcore, spreadsheet level detailed analysis, and that's not my stronger suit. So I rely on their information, but then I also, show up in person and meet these people. And so I kind of combine all of it. And the reality too is that I'll kind of clue everyone into a secret about turnkey world. What do we call it? I don't know if we called it the cycle of psychosis or something, but there's something with turnkey providers, and it's not as prevalent now because, like I said, the turnkey providers who are out now and who have been kind of in the game for a while, they've withstood everything, which means they're worth their salt. And so it doesn't happen as often now, but over the whole time I've been working with turnkeys, we can work with a turnkey provider who is just fantastic. They are providing the best properties on the planet. Everyone's happy. The communication's going well. Everything's panning out as planned. And then it's overnight, something happens. And they're a crazy person after that. We had one provider that went completely belly up because of a nasty divorce. And we're hi? Wait, what? What just happened? And, so there's, we do as much due diligence as we can on these providers. And that's why it's so important for investors to learn due diligence as well, to verify the property that you're buying itself, because ultimately the property, if you know how to do due diligence, which a lot of people don't really know how to do it that thoroughly, you can verify everything about a property that you can, and at that point, it's almost like the turnkey provider themselves doesn't matter. Where it does kind of matter is because so many people don't really know how to do that level of due diligence, you are kind of trusting the turnkey provider. But with the standard turnkeys, if you verify everything on your own, at that point, it doesn't really matter what the turnkey provider does, because once you own a turnkey, it's like owning any other rental property. So, so this is all kind of say that there's a caveat to, we do as extensive due diligence as ever living possible. Like I said, I've got multiple teammates where one person's really good at the market analysis, I'm really good on the buyer side and the general common sense communication side. And it's surprising that has to be a skill in real estate, but there's different people in the equation. We always have boots on the ground. We never promote a provider that that one of us hasn't gone to meet in person and toured all the operations. But with that said, we are still talking about real estate and anything can happen. And, so that's just kind of a, little caveat just to remind people that, some people, especially the newer investors, come looking for a turnkey and they're looking for perfection. And as good as I do, being in real estate, you oftentimes just need to put a helmet on. It's an interesting industry. There are no guarantees anywhere, really. And, so that's why the education part is so important, learning the fundamentals, all that kind of stuff. So what we really kind of try and poise ourselves as is we are looking into these people as good as we can. We want you to also participate in judging, the value of what you're doing. We're really just connecting. We're like, hey, we have reason to think that these guys are really good. And, feel free to check them out. And that's kind of what our role is. And we don't legally represent anyone anyways, but we want your brain involved also, because we don't claim perfection. Things can slide by us on occasion too. And we'll be the first to tell you here's the red flag we're seeing, that kind of stuff. So we really try and make it a team effort, but that's one advantage to, working with someone more like me or someone who does it like I do versus a direct provider, is because you kind of have that extra support system versus if you just go direct to a turnkey provider and you're like, hey, I want to buy a property. And they're like, okay, you're on your own at that point. Whereas in the equation where I kind of fit in, again, I'm that customer service buffer. We can help you, support you. If you have questions you don't want to ask them, you can ask it to us, and, kind of just try and really make it a team kind of effort to help us all out in this industry, because it can be a little bit of an intimidating industry. We all know that.
Yeah, I think it's smart to be prepared for problems. Anyone who's buying real estate for the long term, flipping houses, anything you name in real estate, I mean, there's going to be problems that pop up, and it's not going to be as simple as buying a few shares in a REIT on the stock exchange where you can just click a button and then it's gone. It's going to be a much different, I would say, higher stakes, higher reward, higher risk type of a proposition anytime you're getting into the real estate business. So as we wrap up here, Allie, would you mind sharing a couple book recommendations, maybe one or two for the newer investor who hasn't really bought anything, and then maybe one or two that you might make to me who buys and sells and does a lot of business in the real estate thing?
Well, I probably don't have to recommend Rich Dad Poor Dad. I'm sure there's probably not anyone on listening that hasn't read that. That really, I mean, it sounds a little cliche, but it really is. It's what got me my start. It's what I know got a lot of people their start. It's really just a different perspective on money and realizing, how money really works. So I'll not count that as one of my recommendations, but that certainly is the number one thing for me. I have one that I like to recommend to people. It's a little bit off the beaten path because it's not actually a real estate book, but it's a business book. It's The E-Myth Revisited by Michael Gerber. It's a very small book. You can read through it pretty easy, but it's geared towards, I don't know if it's geared towards small business or entrepreneurs or whatever, but what I really like about it is it talks about working on a business versus working in a business. And in the case of real estate, it's no different, because if you're in real estate investing, you essentially are running a business. Even if you're just buying passive rental properties, that is a business. And so what I really like about this book is it gives a perspective as to what mindsets are required for any business to succeed, which are very basic mindsets. And really, it kind of helped me. It's just kind of almost general life advice also. But he uses an example of a small business and talks about the difference of working in that business versus working on that business. And even if you plan to be the most hands-on investor possible, it's still good to understand all of these dynamics. And so as much as I recommend Rich Dad Poor Dad, I have just as easily recommended The E-Myth Revisited by Michael Gerber to pretty much everybody. So it's, again, a small book, easy read, not real estate specific, but it can absolutely pertain to your real estate business in a very, very good way, I think.
Yeah, absolutely. It was a great one for me. I went back and reread it a few years after I started the business, and it was like even more impactful the second time through. So I had a similar engineering experience. I went to Villanova for about a year and a half, but how it went down for me was like we were there for the orientation, and we like get, they pile us into the auditorium, and he starts telling us what the engineers were going to make starting out of school, and it was like a 5-year program, and I was like, oh, I'm in the wrong place. I knew I had to get out. So I had some of that, engineering background and mindset, but I did not stick around for the degree. I had a lot of other life things going on back then too, but by the grace of God, here I am, and I'm blessed to be on a path, having this conversation with you today. All of that said, Allie, if you could go back to your younger self when you were like maybe walking into, or maybe your last day when you were graduating with your engineering degree there, and you could share the crown jewel of wisdom with yourself, knowing what you know now, what would that be?
Oh, this is always a tough one. There's so many options. It's funny because it's kind of like there's so many options of what I could have told myself versus everything worked out perfectly as it was. So I would say, in the light of real estate, when I was working on my engineering degree, of course, I was all numbers all the time, and I was doing everything that would be applicable to real estate, and all the while I was not thinking about real estate. So I guess it feels like a little bit of a kind of almost pointless advice for anyone listening, because anyone listening is obviously already thinking about real estate. But for me personally, when I was 18, I wish I had thought about real estate sooner because I could have planned for it. And, whether that is saving money for capital or whether it was going to be to start looking into things, because at that age, I really had that learning mindset. Like I had been in school forever. I was in college, and, it would have been such a good time to really start diving into it. Like I wonder aside from, my portfolio might be a lot bigger, but I feel like our brains are a little bit different at 18 and through college than they are as adults, and I feel like it could have taken in so much more information. So my advice would have been just really to start looking into real estate and maybe even entrepreneurship sooner versus, I don't want to take away my whole engineering career because it definitely contributed positively, but at the same time, I feel like there could have been a lot of wasted years of not investing where I could have built things a little bigger.
Yeah, it's interesting. It probably did work out as it was supposed to. I'd read Rich Dad Poor Dad when I was like 19, 20. My dad gave it to me. It was probably when it just came out back then, a few years. I also remember reading when I was still in high school. I read a book by, I don't even know who it was by, but they talked about, the forced appreciation in equity thing. But like, I think for me, the mental barrier kept coming in like, well, I've got to make a pile of cash first, then I can go do that. And it's like, through wholesaling, through flipping houses, leveraging equity partners. I mean, that's not the case, and you can do it before then. And I know that that's a big roadblock for a lot of people I talk about is, hey, I don't have the capital yet. You got to go get the deals first. But all of that aside, that's pretty cool. Pretty cool. Wish we would have done it. If you're not doing it, do it now for the audience. So, Allie, do you have a website, or if somebody wants to get some more information about you, your company, maybe reach out and talk to you directly, some contact info you'd like to share?
Yeah, definitely. So I actually set up a link just for your folks. If you go so my company's name is Hipster Investments. For the record, I am not a hipster. I'm not even close to it, but that's my company's name. If you go to hipsterinvestments.com/diamonds, I put on there a link. So I wrote a ebook a few years ago. It's Turnkey Rental Properties 101, the definitive guide to hands-off rental properties. Like I said, I used to be one of the culprits of calling them hands-off, but that's what the name is. And it normally sells for $14.99, and I have a link on there where your folks can get it for free. So if you go on there, you can get the free copy of the ebook, and there are links in there and on there, like my social, my email address. You can absolutely contact me through there, but for sure, head to hipsterinvestments.com/diamonds and you can find me there. And for the record, I love talking to people. Like I love meeting more people, so don't be shy. Don't think you can't say, even if you have nothing to say, just reach out and say hi. So I'm all for it.
Nice. All right. Sounds good. Head on over there and check that out. Allie, hey, I really appreciate you making the time to, set aside, block out the distractions and come on the show. I really appreciate you coming on the show. It's been a fantastic episode.
Awesome. Well, thank you so much for having me. I love talking about this stuff. So it's very cool to get to hear different perspectives and share with you guys what I'm working on and, just meeting new people.
Thank you for tuning in to this episode of the REI Diamond Show. As you've probably either heard me say during the show or simply noticed by the content and format of this podcast, I don't offer any coaching programs, seminars, or online courses. I created the show as a platform where I'd have interesting conversations with very successful guests from around the country, guests whose normal life and course of business would usually keep them so busy that they just don't have time for conversations like this with anyone. I am so lucky over the past few years to have hosted this show, had these conversations, and learned and implemented more ideas than I can count. So I'd just like to take a moment to announce my gratitude for all of the guests who have come on the show, shared of the wisdom so generously. None of this would be possible without you. By the way, if you have an interesting story, some unique value that you'd be willing to bring to the show, you can always apply to come on the show as a guest at www.reidiamonds.com. These conversations have been like a very loose mentoring program of mine, albeit with a random, mostly real estate knowledge focus. The best part? They're recorded so that we can all listen in and listen over and over again if we choose. The other life-changing benefit for me of hosting the REI Diamond Show has been the introduction to many people who are now long-term partners with me in running Diamond Equity Investments, the house flipping company, which I founded like 14, 15 years ago and generated $5,126,000 in profit last year alone in 2019, flipping houses in Atlanta, Chicago, and Philadelphia. My ideal partners have been fix and flip investors and sometimes wholesalers who maybe managed to, have a few decent years in the business, but mostly, the people that I'm thinking about have been worn out by one of the two following things. For the flippers on the team, they've gotten tired of inconsistent quality deal flow. We all know if we've been fixing and flipping deals, finding the next deal can be a problem, and suddenly there's too many deals on the plate. And for the wholesalers, they were tired of paying that ever-increasing marketing costs, eating away at their profits and having trouble, finding that sustainable business model, as it were. And those ideal partners connected with me at our networking events, which we host about once, maybe twice a year now, or just filled out the form at reidiamonds.com, and eventually we connected and, kind of stayed in touch, and a little bit of time passed, and eventually they joined the team, where the leads and deals come in high volume. I don't actually hire people, quote unquote. I'm not looking to hire anyone right now, but I'm always on the lookout for the A players with whom I can expand Diamond Equity's team. So in the next episode, you'll have an opportunity to catch up on the coming potential shift in the real estate industry because of cryptocurrency. While I believe that crypto may provide an opportunity and improve many industries, I honestly believe the crypto bubble, from an investor's standpoint, is about the same as internet stock bubble of the late 90s. the internet itself, which was driving the valuations and the prices of those stocks sky high, the internet, coming internet of the late 90s itself, it did bring sweeping change to business, to real estate, and it continues to do so to the entire world. However, selecting the winning investments in the 1990s stock market, such as Amazon, it was there during that time. Selecting the winning investments in the internet stocks proved very difficult and even bankrupting for most investors who are playing the game of stocks in the early 2000s under the guise of, well, the internet's here and it's going to rise all boats and it's going to change the entire world, and so we got to invest in the internet. And I feel like crypto is kind of the same story playing out again. And maybe I eat my words and everyone gets to laugh at me and I miss out on these gains. But next week's guest is actually, he knows my position. He knows that I'm a cryptocurrency bear when it comes to investing. I think it's a very difficult place to win, and maybe I'm wrong. But he agreed to come on the show and debate the direction that crypto could have on the real estate industry at large. While this isn't quite the real estate investor-specific tone that most of our episodes normally take, you'll surely enjoy the dueling points of view throughout the show. Well, that was a doozy. Let's wrap this thing up already. Thanks again for tuning in to the REI Diamond Show. Until next time, Dan Breslin, signing off.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.